Greetings, everybody. Welcome into the Mining Stock Daily long form episode for this week. A little bit of an off week as I am heading out on vacation. So we're going to air this long form episode earlier in the week. I'm happy to welcome in a good friend of mine, Julian Brigden of Mi2 Partners. We talk all things macro. What are the things he's watching right now? How has this market changed in the last 14 years? It's all about liquidity. We've seen this over the last 6-7 months, or if not longer, but there's a divergence between this move in the general market and where liquidity sits right now. And what something else has to give here, according to Julian, the market, the stock market, or the bond market. So one to watch, and plus where do commodities fit in all this thing? I pose a couple of trades that I have on right now, and I get his feedback on it. It gives me some food for thought. Special thank you to Fireweed Metals, Arizona Sonoran Copper, and Western Copper and Gold for their continued support of the podcast. Please hit that like and subscribe, share with your friends, all those things, both with the podcast and on the YouTube channel. Let's jump into this great conversation with my friend, Julian Brigden. Greetings, everybody. Welcome into the Mining Stock Daily long form episode for this week. A little bit of an off week as I am heading out on vacation. So we're going to air this long form episode earlier in the week. I'm happy to welcome in a good friend of mine, Julian Brigden of Mi2 Partners. We talk all things macro. What are the things he's watching right now? How has this market changed in the last 14 years? It's all about liquidity. We've seen this over the last 6-7 months, or if not longer, but there's a divergence between this move in the general market and where liquidity sits right now. And what something else has to give here, according to Julian, the market, the stock market, or the bond market. So one to watch, and plus where do commodities fit in all this thing? I pose a couple of trades that I have on right now, and I get his feedback on it. It gives me some food for thought. Special thank you to Fireweed Metals, Arizona Sonoran Copper, and Western Copper and Gold for their continued support of the podcast. Please hit that like and subscribe, share with your friends, all those things, both with the podcast and on the YouTube channel. Let's jump into this great conversation with my friend, Julian Brigden. Greetings, everybody. Welcome into Mining Stock Daily. This is going to be this week's long-form episode. A little bit of a shortened week for us here on the podcast as I am on vacation. Got to spend some time with the family. And why not take an all-American road trip to none other than Mount Rushmore, South Dakota? My guest here.
Lucky you, mate.
If you couldn't tell, this is our guest, Mr. Julian Brigden from Mi2. Julian, we are here in the Vail Valley. We're going to be back here this fall because you and your team are putting on a conference, macro conference.
We are, yes. We've had this one in the hopper for a while, and we were just discussing how many conferences there are, but there's a lot of conferences that, you come away, maybe you're smarter. Okay, maybe you're smarter.
Right.
But you're not, I don't think, necessarily richer. And the whole thesis behind Mi2 right from the get-go is not to pontificate about, the markets or the economics. It's to try and make people money.
Mm-hmm.
And that's what we're really going to try and do at this conference. So we're going to talk about, don't get me wrong, we're going to talk about the macro. 2024 is a big year, right? We've got, big US election. It's going to determine a lot. We've got some pretty shitty geopolitics when we look out there. I know Yellen just came back from China. It's all fine, honestly. It's all fine, right? So we're going to be talking about things like that. But then on the second day, we're really going to be taking a lot of that information, and we're going to be starting to help you guys figure out how to make money out of it. So not only just trades, and this is the important thing, because 90% of you don't really trade per se. You really want to position your wealth. That's how you really make money. And so we're going to have a couple of guys that we really like who do portfolio management, but for individuals, talking about how they potentially see the world and how they want to position themselves and their portfolios for potentially what I think, and we're probably right seeing it now, Trevor, the fundamental big shift. So that I just think the last decade has been quite unusual. I mean, we've seen them before. We saw them running into the 2000, 2001. We saw it arguably running into 2007, 2008. And we've just had this gangbusters period since really 2011, where everything's kind of gone everyone's way, where you had to be a fucking idiot if you didn't make money. And now I think those dynamics are changing, and I think the big shock's going to be to people that it's not that they're not going to make money. And I was on chatting to Raoul just now for the Real Vision conference call that we do monthly. I just think where you can maximize your wealth creation is going to be very, very different over the next decade than the last decade. And I think we're potentially seeing the beginning of that trend like now.
Wow. So there's a number of things I want to take this conversation for as long as I can, have this conversation. I want to talk to you about this divergence between the bond market and the equity market, or lack of divergence, I guess we could say. I also want to talk to you about inflation, and then we've got to talk about commodities because they've shown signs of life, not only in energy and metals, but also precious metals in the last few days. So that's kind of the direction I want to take this. But so I think we need to start with the big news with the CPI print. We got 3% year over year print. All of a sudden, people are up,
Ooh, ding dong, the witch is dead.
Yeah, inflation's over. And I know you and your team, you dive deep into that report, and I was able to have a conversation with you. It's like, there were only a few things that really kept that number low as it is, and that's energy.
Yeah. And I think, look, we, as you know, in 2021, inflation was our big trade, and we had these really ballsy calls on how far inflation was going. And I remember going on a virtual roadshow in 2021, because we're still obviously locked down because of COVID. And there was one guy from some huge hedge fund who got off the call and called me back and said, "You're fucking insane. How high do you think CPI is going to go?" Well, we were just trusting with what the models were basically telling us. And that was, if you threw a monumental fiscal and monetary stimulus at the economy, the odds are you were going to get very, very high inflation. On their own, they aren't enough. So you can just look at the monetary stimulus. Historically, if you blow out things like a balance sheet of a central bank or M2 or other monetary aggregates, you can sometimes get inflation, but you tend to get asset inflation. You don't tend to get real inflation. When you combine that with fiscal, that's the sweet spot, right? So we played that game, and then last year, a month before the arse high on CPI, we said, that's it, down she comes. Now, it's been falling, and we think, and so far we've been happy with that. It's led us to have some trades in fixed income, but those haven't really worked brilliantly well this year. It's been quite a frustrating year in fixed income. But the thing that I worry about right here, right now, is this concept that ding dong, the witch is dead, right? This is it, we're done. And to your observation earlier, an awful lot of this is energy.
Yeah.
Right? An awful lot of this is energy. And energy, because of the very nature of how we measure CPI, is all about the rate of change. CPI is the rate of change. So suddenly if, oil drops from 100 to 50, okay, that's a 50% decline. But if then oil goes from 50 to 75, that's a 100% increase. And part of the problem is those very positive base effects we've had from falling commodity prices and falling oil are going to start dropping out. And I think are dropping out. This is probably the arse low. Now, don't get me wrong, Trevor, I'm not expecting an explosive acceleration from here. But this very, very positive headwind disappears. And I do expect that headline PPI and CPI will start to rise again. Okay?
Yeah.
Now, that in turn leads to the next question. Headline rates, fine. What happens to core? Right? Because that's really the bit that the Fed's most interested in. And then again, I still think we're in danger of starting to see less of an improvement. I do think there is pressure on those core metrics. I do think they're going to soften, but the question is how far. So, for example, if you look at one of the things that JP's been talking about, Jay Powell, right? He's been talking about service inflation, ex-housing, okay, and ex-shelter, and that has fallen pretty sharply. But once again, if you look at service inflation, ex-energy, right? So you take that energy component out, it is still stuck there at around 6%. So the stuff without energy has dropped very hard. It's stuck. The stuff with energy in has dropped very hard. Now, if those base effects once again start to reverse, maybe we'll get a little bit further down on the core stuff, and then they start to get sticky. This concept, which the market really has fought the Fed in since the frigging beginning, that not only are they done, but they're going to be slashing rates, right?
Yeah.
And we're talking about major rate cuts getting priced in, right? We're talking, over 100 basis of rate cuts in by next December, right? That's really only possible if somehow, I think, you really get a recession. I don't even think it's good enough even if we got zero inflation. And the reason I say that is because what's actually the fundamental problem that the Fed's been fighting is we have too much inflation, but we have too much nominal GDP. So overall GDP plus inflation is too high. So that's still running, if you look at the labour market, which is basically what leads it, it's still running at around 6%, 6.5%. So let's imagine tomorrow morning we woke up and we had the equity bulls wet dream. They woke up and CPI is 0, okay? So your nominal GDP is 6.5, your inflation is 0. Where does your real growth have to be? 6.5. Now, slight problem. Trend GDP, real GDP, is 1.75. So we're going to be growing at 4 times that? That's the idea? And in an economy where we've got 3.6% unemployment, that's sustainable? No, of course it's not. So what would happen in that environment is real growth would massively accelerate. You try and employ all these people to fill those positions. And I know eventually we'll replace them with bloody AI, but it won't be this year, right?
Right.
Your core inflation metrics, which are driven by your labour market, will just punch higher or will remain incredibly sticky. And the Fed won't be done, right? They will not be done. And this is why Jay Powell keeps talking about we need a period of sub-trend growth, right? He says we need a period of sub-trend growth, we need lower inflation, and we also need slack in the labour market. They can't say, we really need to drive unemployment significantly higher, because that would get their political balls in a vice, right? But that's essentially what they're setting out. And what is going on in markets at the moment is utterly contrary to that. So something is going to give, Trevor. It's either going to be that we're going to find out that this equity market, really is a bubble. We're very stretched versus the underlying liquidity metrics right here. So could that correct in the next few days? We're starting to get sell signals and exhaustion signals on the S&P and the NASDAQ, right? So maybe they do come down. Or this thing sits here, keeps going, and the bond market is smoking crack in that scenario. They're just not going to get the rate cuts that they think. They may even get rate hikes. And, that's to me where it's just been such an incredibly difficult trading environment.
It goes against everything that you've been taught. I'd say, yeah. I mean, all of us. But, there's always been this divergence between the bond market and the equity market. Right. But if the last 2 weeks have taught us anything, that is not the case anymore. Because as the labor data came out with ADP and non-farm payrolls the other week, we saw bonds sell off, yields rise, but so did the equity market.
Right.
And it was I think it was a very telling couple days
Yeah.
with that.
It's, you know, we talked about this before we got on air, and we've done a lot of work going back a few years now where, you know, in the good old days, let's say, 08, 09, pre the GFC, and before we got into this absolute stupidity of QE, the correlation between bond yields and equity prices was negative. Bond yields or interest rates would rise and equities would generally fall. I mean, it's what's supposed to happen, right? You tighten interest rates, it's supposed to slow the economy, and it is supposed to weigh on the equity market. It doesn't actually happen anymore, Trevor. In fact, you know, it's quite the opposite. And I think the fundamental problem is that you've taken the equity market from being a metric of economics. Now, don't get me wrong, the economics dictate the relative performance of sectors within the equity market, winners and losers. But the broad equity market now is utterly determined by liquidity. Right? I mean, it's utterly determined by liquidity.
Yeah.
Right? We have done a Weimar Republic, so sort of Germany, you know, in the hyperinflation of the 1930s, trick where we have debased the currency and tangible assets, which are a claim on, you know, cash flow, have risen in price. Right? You've debased the denominator of those assets, which is the dollar, and up the asset has gone. And so you're now in this world where equities are basically set by liquidity, and they don't give a shit about interest rates. And typically what you've seen is as liquidity has been increased and equities have gone up, bond yields have actually risen because liquidity is itself reflationary, right? So if you boost the wealth effect and you make CEOs feel better, right, then generally your equities are going to outperform, but so is the broad economy. We can talk about that correlation in a second. But the point is the Fed's is fighting with one hand tied behind its back, because the only thing that they seem to be able to control now, I think, as we move into August, September, October, which is why I'm still worried about asset prices and particularly US equities, I do think that we're going to get more of a liquidity tightening going on. But they've basically been battling this situation where they've been trying to slow the economy down via rate increases while not being able to do anything about liquidity. Because yes, theoretically they're doing QT, but as we saw, the Treasury offset a lot of that QT by drawing down the Treasury General account, which is kind of their checking account, and that offset some of that. And then the Fed had to backtrack to bloody bail out the banks post SVB, and then they pumped even more liquidity in the system. So they're really trying to battle this, and this makes slowing an economy down where you're only impacting certain sectors. We call it this kind of haves, not conundrum that they have. Incredibly hard. And the two key things are just equities are set by liquidity in broad terms. And the bond market is set by what the Fed does with rates. But it always has to keep one eye on what's happening with this liquidity metric.
The function of the market and the bond market have completely changed over the last 15 years, since the great financial crisis.
Yeah.
The utility of the market, of the stock market alone, is completely changed.
Yes.
Dimitri Kofinas calls it the gamification of the market. There's more participants in the market now than there was 15 years ago because of technology and having access to your trading account every minute of the day.
Yep.
So this changed over the last 15 years, and you come from an old school, an old school training in the markets, and I'm sure you've had to just stay on your absolute toes for the last 15 years because this whole thing has just changed before your very eyes every day. Yeah,
it does. I mean, you end up, using, we wrote back in, I think we were breaking back up above, not quite 3,900. We use these simple moving averages to keep ourselves kind of honest. Because look, at the end of the day, I'm a macro guy, and there'd be nothing more than I love than the equity boys to get that half glass full of theirs shoved up where the sun don't shine, right? But so we like to keep ourselves honest, and we use these simple moving averages, and we got a buy signal in the S&P. We've got a buy signal in the S&P, and we've got the economy slowing and all the metrics slowing, and screw this sort of service sector versus not, right? And to say that it was a struggle, and we wrote to our clients saying, look, I mean, we're really struggling with this thing. But the point is what was driving it was liquidity. And then you add into that, Trevor, this complication that you've got, that I truly believe that in the US, we use the phrase hyper-financialized.
Right.
And what we mean by that is very simply that if I said to you, which is the chicken and which is the egg? Is the real economy the chicken, or is the financial market the chicken, right? Which leads the other? And you kind of say, well, from a logic perspective, the real economy should set inflation, so it should set bond yields, it should set growth, set bond yields. It should set profit margins, essentially from that growth. It should set employment, all of those things, right? That should lead the financial economy, not in the US. Right. We live in such a hyper-financialized environment that literally stock prices, when you look at them on a correlation and regression basis, lead virtually everything,
right,
with the exception of liquidity, which leads them.
Yeah.
So you've had this situation where, yes, last year we had the Nasdaq under pressure, we had US stocks under pressure, and what did CEOs start to do? Start to lay people off. Right, we saw it in the tech sector towards the end of last year. Now, stocks based in December, what peaked in January? Layoff announcements.
Right.
Literally, if you cannot get the equity market down, it's going to be extraordinarily difficult for you to soften this economy. And the Fed, and we've said this, we've literally used the expression, is in a pissing match with the equity market. And it's, they're being hosted by their own petard in the sense they created this situation by pumping in trillions, right? 2 trillion into the repo market, right? And 4.75 trillion on their balance sheet just since COVID, right? Mm-hmm. Just since COVID. I mean, this is 30% of GDP in footloose liquidity that can just sort of, morph all over the shop. They've created this dilemma, but I think, to me, we're going to have, don't get me wrong, as I said, I think equities look extended here. We're beginning to get some sell signals. There is some weakness in the economy, right? There is some genuine slowdown in employment. But if we do not get that correction in equities, and it's a meaningful correction, then actually I fear this bout of weakness we're seeing here, to use, and I hate to use this phrase, could be transitory. And then come Q4, the economy's re-accelerating again. This inflation base effect, excuse me, has dropped out, right? And then the Fed's in a fucking...
So buy the dip one more time.
Yeah, then the Fed's in a world of pain. But on the buy the dip, and I think this is where things get interesting, the question is, what do you want to buy? And that, to me, is why the dollar is so important here.
Well, let's talk about the dollar. I've been watching that chart real closely. It fell through support in one day.
Yes.
From, what was it, 102-ish to 100. And we're talking here on a Thursday afternoon, it's down into double digits. I think I saw 99.
Yeah. Yeah.
So
it moved against the euro, 3.5% in 5 days.
Cut through support like butter, man.
Yeah.
And I think that was a pretty huge signal. However, equities are rallying, commodities are rallying. I mean, everything seems to be rallying.
So we all think, as I said, the Fed is done, and maybe they are for now, right? As I said, I question for how long, and it may only be 2 months from here now, and we're looking at higher headline inflation prints, right? And no drop in the labour market, and then if the Fed doesn't keep hiking, the bond market is going to do it for them, because there's no way that bonds can keep pricing what they're pricing if this economy re-accelerates and doesn't weaken. But the dollar, to me, gets really interesting. So we've really been in the camp that for a while, and it's been a bit of a bitch to trade because it looked like it was going last year just before Ukraine. Mm-hmm. that the dollar has these very large, big cycles, right? We're not talking, please, don't anyone, think that I'm being sort of tinfoil hat wearing Machiavellian and saying, the demise of the dollar is the reserve currency. What sane individual, what Western country is going to want to put their money, or most of it, into the currency of a communist dictatorship, right? No one, right? No one. So don't get me wrong, but the dollar moves in big cycles, and we've been due a correction. We've had the best part of 12 years where the whole world has piled their money into the United States for creating a bubble in the equity market and a true Soros-esque reflexive cycle, so a reinforcing cycle whereby the purchase of the asset underpins the economy and the economy underpins the asset price. So we have this self-reinforcing virtuous cycle, and it's friggin' extended here, Trevor, right? So if we are going to get a broadening of the recovery and ding dong, inflation's dead and everything's going off to the races again, then there's a shitload of better stuff to own than bloody NASDAQ stocks, which, if you look at the NASDAQ 100 against the Russell, for example, right?
Yeah.
It's at .com high extremes. It touched the arse extremes like 3 weeks ago, right? 4 weeks ago.
Mm-hmm.
And, if we're going into a new phase of reflection, kind of question it, but if we are, and I think you can trade it for, at least you can trade it. Now, positioning, maybe not, but you can certainly trade it as though we are. Then the stuff that people own, US stocks, particularly consumer discretionary and tech, historically are the things that you do not want to own. It doesn't mean that they go down, but there's better things to own, even in the US.
Well, there's a number of ways we could take this, because I one of the things I actually wanted to get your thoughts on was this idea of re-industrializing America and this quote-unquote Inflation Reduction Act, which is poor choice, poor definition.
Very poor choice. Yes.
But however, it is...
the Fire Retardation Act. Pour this gasoline right over this.
Yeah, exactly. But, at the heart of it, and I think this has been something that's been going on for a number of presidencies, it's just this act has got Biden's signature on it, right?
Correct.
So we got to get to a point to where we know the world is deglobalizing, supply chains need to be corrected.
Yep.
We need to put people back to work. We actually need to produce things rather than, as you say, hyper-financializing everything, and bring that financialization of the GDP back down to
something more reasonable
than what it's at right now. But that's going to take a shit ton of planning, a shit ton of money, and a shit ton of get off my back NGOs, environmentalists. Right. This is something we have to do. Are we prepared to do that? I mean, because it seems to be very political. On one hand, people want to do that. On the other hand, politically, you got to tread very, very lightly. But what does that mean? I guess what does that mean for the real economy?
So look, don't get me wrong. I think we are definitively re-onshoring. If you look at manufacturing, sort of production capex, right, it's exploding. It's gone up 100% year over year, right?
But manufacturing has also been in a recession for the last 4 or 5 months.
Well, that's because they just over-ordered shit, right? In COVID, and now they're paying that price. But if you look at the construction, it's happening. I do think you have to be careful, right? I mean, we're starting from a pretty low base, right? My first boss said to me when he gave me my first pay rise in the business, he said, "Julian, I'm giving you 100% pay rise." And I said, "That's great." And he goes, "But I do want you to remember that 100% of fuck all is still fuck all, right?" and I was like, "Oh, okay." But the point is, so 100% increase in manufacturing, sort of business plant investment, is great, but it's off a really low base, right? Because we've hollowed out manufacturing for 20 years, right? So great, right step. Is it important? Sure. Is it going to prevent us from having a Should it prevent? Is that enough to prevent if everything else is tightening? And, you know, like, is that going to offset commercial real estate? No. Right? Is that going to offset the tightening of the bank balance sheets? No. Right? So I think we have to put all that sort of in context. But there's a lot of demand. There's a lot of, and everyone's doing it, Trevor. Mm-hmm. So there's a lot of demand on a lot of these industrial commodities going forward, irrespective, right, of what happens. We're writing this piece on hydrogen at the moment, right? Because, you know, Biden put billions of dollars into this, right? Tens of billions of dollars into this stuff, right? So even if we go into recession tomorrow, there's going to actually be an underlying bid. But the big thing, guys, that's truly going to drive this is if this dollar goes. Because one of the, you know, in macro, there's really, the cycle is about getting the dollar cycle right. Because, you know, yes, there's the underlying growth cycle. The underlying growth cycle will determine, you know, what used to determine whether you should have risk on or risk off.
Yeah.
Now is liquidity going up? But what really determines within that trend of risk on or risk off of where you put your money is the dollar. And history suggests that in a risk on environment, which we certainly are as we sit here on Thursday, if the dollar is going down, it is not in growthy US tech stocks. It is actually in the real economy, and it is actually, you can do it in the US, you can own mining, you can own metals, you can own actually transports. What you do, but really you also want to own some emerging markets, you want to own non-US stocks in those mining metals, right? You know, the FTSE is a great equity market to own in that kind of environment.
Well, let's talk about commodities and metals,
Yeah.
because it's been pretty fascinating. I've been watching copper very closely recently, last couple of weeks. I mean, that was very unfavorable with copper for a long time. A lot of people are a lot of people watching copper, they're in many ways much smarter than I am, but kept on pounding the supply demand, future supply, future demand. Totally understand it, but I just said the chart didn't look great.
No, it's not right.
But it did bottom, got a bounce, and actually made a higher bottom.
Right.
And now here we are in this interesting couple of weeks we've had, and it seems like it's rebounding. But if Dr. Copper is giving us a sign of the economy, I mean, I guess that's an anecdotal situation of the entire commodities situation right now. We're also seeing oil rebound.
Yeah.
I mean, how are you approaching commodities?
So look, my core view has been, and it's something that we've talked about with our sort of macro insider crowd, you know, when we look at these longer term trades. You know, one of my favorite longer term trades is basically short the S&P, long the XME. And it's been, you know, frustrating trade. It hasn't really gone anywhere. It hasn't really, you know, massively underperformed. But it's really a dollar trade, right? And you look at those ratios historically in the past, and I can't remember exactly where the point is if we're going into the beginning of a long downturn move in the dollar, and don't get me wrong, I don't think it's going to be quick. It's not, you know, in the sense that we're not going to get a clear resolution of this, right? To get a clear resolution of the dollar, ideally, what you'd want is the Fed to be cutting, and I struggle with that given what we've just discussed, Trevor, and this idea that, you know, oh, it's all great, we're actually re-accelerating, right? Now, if the equity market in the next couple of weeks shits the bed, okay, then fine, okay? But that would put you in a situation where, you know, the dollar would start to weaken, they start to cut, then you can go, I think, balls to the wall outright commodities, right? So you go just absolutely balls to the wall, long copper, long XME, you know, long, you know, oil, right? At this point, my inclination is still more of a relative trade because you just haven't got that clear Fed, we're done.
Well, but the traders seem to think that's the case. I mean, is that what the move is right now?
Yeah.
You think it's all speculation?
Absolutely. And I suspect, if I'm right about, we fast forward a month,
Sure.
and everyone's expecting CPI to fall from 3 to 2, and it goes to 3.5. That will be the question mark. If the following month it goes to 4, right, we better have some bloody lifeboats available. Because things will get really ugly really pretty quickly. Or if, your initial claim starts dropping again, right, then, it's just not that simple. We went back and looked at every single recessions in the post-war period and what that typically did to inflation. Okay, so we took from the start of the recession to 1 year after it ended. So roughly somewhere between a sort of 2-year and an 18-month time frame, right, from the start of the recession. And what it basically said was that core inflation dropped 0.9, right, over that whole period, 0.9, and headline only dropped 1.9. The point is, even in a recession, Trevor, to say that inflation is dead, and we haven't even had a recession, and it looks the way things are now that this is not the case. So as I said, bare minimum, if indeed we are re-accelerating, this assumption that the Fed is going to be cutting next year, I think is wrong. I don't see how they can. Bare minimum, they're not cutting. And that means those sort of 2-year notes and 3-year notes, 100 plus basis points mispriced.
Yeah. They're prepping a wedding out here.
Yeah.
I mean, that's all right. It might be our curtain call to wrap it up anyways, but let's kind of jump on board with that, because it's right now, I'm starting to buy copper plays.
Right.
And I put that out there on Twitter a couple days ago. I've been buying my favorite copper juniors, the riskiest of the risky.
Yeah.
But now that I'm listening to you talk, I'm realizing, like, I've got to be very careful, tread lightly, and be able to get out if the macro doesn't support the trade.
Yeah, and I think, look, don't get me wrong, there is nothing more in the world that I would love to just go all in on black, right, and say, just buy silver miners, just buy gold. I think you've got to be careful on the copper stuff because it's real economic growth kind of stuff. But, even that, right, there's nothing more than I would like to, and then go short Nvidia, short bloody Tesla, short Microsoft, right? I'm not convinced you can just yet, right? I think you can do it for trade. I might be wrong, but even if you start to, as I said, right here, right now, my inclination is more to have relative trades on, to have 2 legs. So I might be long copper and short. I mean, you were just saying you're basically long copper and short NASDAQ, right?
I am. I am.
And I think that's a right kind of a way to approach it right here, right now. And then you can lift the leg at some point and take that NASDAQ money and go, right, all on.
Well, but I'm wondering if, maybe this is just me thinking out loud with my current position is, and I need to maybe think this through, but am I positioned here because it's fundamentally sound to have those positions on? Or in the back of my mind, am I thinking, holy cow, the market they're way out in front of their skis, and this bubble still hasn't popped. Am I playing a bubble pop? And that's really dangerous.
Okay,
that's a really dangerous
It's a very
position.
difficult thing to do, and I have a lot of sympathy with that. Right, I do think.
Thank you.
No, I mean I do. I look at US stocks and they look highly bubblicious to me. Right, as I said, if you look at go and pull a chart up, guys. Most of you all have charting packages. Go and look at the NASDAQ 100 against the RTY, the Russell 2000. I think it's the 2000, and take it back to 2000 as a ratio. We top ticked it just like we did in 2000. So you know, I have a lot of sympathy that I think these tech stocks are highly bubblicious. If they are bubblicious, and if that bubble bursts, it's going to be very, very hard to make money in any outright long position.
Yeah.
Right? Your copper is going to go down. Your silver is going to go down. Now, it might go up relative to the NASDAQ 100, but that's a very different proposition from the one that I fear right now, because I just don't see the conditions for the Fed. The market's assuming this, but I don't see the conditions for the Fed to be done and to start to cut rates. And that's when you go balls to the wall, all in. So this to me still is a trading environment. It's moving in the direction that I want.
Mm-hmm.
But I'm worried that if those tech stocks don't come off and those base effects drop out on inflation, we're going to get to September, October, and we'll be going, shit, inflation isn't coming down and the labour market isn't weakening. Are we right to be pricing 150 basis points into, you know, the interest rate curve in the US? And if we're not, what does that mean? Well, it probably means, you know, bonds have to sell off, risk assets come under pressure again, maybe the dollar bounces a bit. So it's all still much more nuanced.
Yeah. I hate to give the central bankers more credit than they deserve, but I have been thinking this in the back of my mind that, like, you know, other than the transitory bullshit,
Right.
when they came out and said we are going to fight inflation, the cover of this inflationary fighting book seems pretty okay. Like, seems like they've managed it okay, because everybody's happy. Inflation's come down, equities keep going up.
Sorry, mate, you can't fucking have that.
Yeah, no,
the immaculate inflationary fight, right? You have to have pain. It's just a market. You've got an equity market that doesn't give a shit about fundamentals, just driven by liquidity. A series of events that have pushed that liquidity higher. You've got a central bank that is trying. I mean, look at it this way, Trevor. If you are wealthy, which a lot of people who be listening to this podcast are, and you have stock, and you have fixed your mortgage,
you're sitting okay.
I mean, what's the Fed done to you? Fuck all.
Yeah,
Like,
yeah.
Nothing.
And that's the cover. That's the book cover.
Right,
Yeah.
right, nothing. Now, if you're a millennial and you're trying to finance a car or buy your first house, right? Bloody hell, right? But the same is true of the equity market. If you're a small business trying to finance yourself, getting finance rates now of 9-10% from a bank, as opposed to a Fortune 500 company, or particularly a top 10 Fortune 500 company, long cash earning 5% on your money, what have they done? But the idea that we can just squeeze this little part of the economy and just kill economic growth and obtain, if Powell is determined to deliver what he has said, kill inflation, right? And that will require a period of extended sub-trend growth. Real growth is now re-accelerating because financial conditions are easing, and a period of slack in the labour market. And the risk is that now, because of hyper-financialization, that slack will not emerge. If we think we're truly done, I think that's just naive. So that's why I'm more in this relative trading. It's a great trading environment, right?
Yeah.
But it is not a balls to the wall, these central banks are done, unless they suddenly determine that they are going to be done. And if they're done, if they back away here, don't bet your money that the long end of the bond market's going to give them the benefit of the doubt, because they'll be pivoting and not delivering on their inflation credibility. And so far, the bond market has given these central banks, exception of maybe the Bank of England and the gilt market, 100% credibility. Right? They really believe that they're determined, that they're going to be able to vanquish inflation. Let's see by September, October if these base effects start to drop out and inflation ticks up a bit.
Yeah. Speaking of September, October, I'm going to see a lot of you this fall.
You are, mate. So, 26th to the 29th, we're having this conference not far away from here, actually, just over in Beaver Creek.
It's actually in the same place where the Precious Metals Summit
is.
hosted. And
yes.
It's there's a 2-week gap, I believe.
But it's a better time of the year. We get peak leaf change. And so it's a...
We're not starting a battle about who's getting the better position.
No. We got lucky. But it's it's a beautiful time. And the reason why I mention that is lots of people get hassle, if they want to come to these things from their loved ones, right?
Right.
I don't want to go to this. It's actually a great time to bring your partner because they'll be able to do a bunch of stuff on the mountain. As I said, and we're having stuff arranged so that they can do that. It is a stunningly beautiful time of the year. And I think, the plan will be, as I said, we've got a few days to talk about all the economics, to talk about the macro, to talk about the geopolitics. It's
going to be incredible timing.
Yes. But, mate, to try and get people to walk away with concrete ideas about how they can protect their wealth. Because if we're right, it's a radically, radically different world than stick all your money in the fucking NASDAQ 100 and remain balls to the wall, essentially long dollars with no international exposure, which none of you have pretty much, right? Most IRAs now, or most, registered investment advisors are probably 95% US exposure, 5% overseas, because it's not paid you to do anything in that. And that's just not what history suggests. And I would think that you really need to be very, very cognizant of the potential risk. Even if you doubt us, you've got to listen to that side of the argument, because I think it would be transformative. And look, if you're interested, go to our website, which is mi2partners.com. There's a link on the top. I think the early bird special is still running. Trevor's got a link.
Yep,
I think
got a link. I'll be speaking.
And Trevor's speaking. We've got a lot of really smart people there. I think you can help.
Much smarter than me, but I'm glad you asked me.
And me.
Yeah.
I always wanted to be the little ant on top of the big, the big mound of ants. So I think it's going to be a great event.
It will be a great event. And then I might also add, in November, you and I are going to be back on a stage together. In Zurich. I don't know if we're going to need. I'm going to have to talk to Jessica because we're going to need more time based on this conversation. But so you and I are going to be giving some. I don't know if it's the keynote or a session or something. I think that agenda is being finalized yet, but you and I will be at the Precious Metals.
I'm coming straight from Carbo.
Oh, you'll be nice and tan.
Have you seen me, man? My ethnicity? No.
Julian Brigden, Mi2 Partners, my friend, my mentor, and love the hell out of you. Thanks so much for doing this.
Pleasure, mate. Thanks for having me on the show.
The information presented should not be considered investment advice. Mining Stock Daily and its affiliates are not responsible for any loss arising from any investment decision in connection with the material presented herein. Please do your own research or speak with a licensed financial representative before making any investment decisions.